Hello and welcome to my trading pit, personal investment tools and techniques. My name's Lundy Hill. This is not investment advice and I am not a financial advisor. Also note, past performance is not necessarily indicative of future results. Today we're going to be talking about gold futures and we're going to do a chart analysis on that using the Elliot wave principle. This is a beautiful chart showing Elliot wave in action. Elliot wave is in reference to a guy by the name of R.N. Elliot. He was an accountant in the first half of the 20th century, and he discovered the cyclical nature and trader psychology, which led him to develop what's called the wave principle of markets. In a nutshell, movement in the direction of the trend has 5 waves up, 3 up, 2 down, if the trend is up. Movement against the overall trend has 3 waves down, 3 waves. 1 wave down, 1 wave up, and then another wave down. And gold has recently played this out beautifully. But first, let's step back and look at a weekly chart of gold. We can see that from the lows of, here's a 2-year chart of gold. It's up 20% from the lows of, or actually from the 2023 close, which was around 2063. And it's up 30% from the fall of 2023 lows of 1811. Either way, that's a great return. And also the key is that prices are staying real close to the high up here. The high is $24.83, $2,483 an ounce. Who would have thought that? We're so close to $2,500. And prices have not even been able to retrace 38%, which is a major Fibonacci level. And to me, that's very bullish. Now let's zoom in on the gold 4-hour chart showing more recent action. We can see, starting from left to right, that we have 3 Elliott primary waves up. These are labeled 1, 3, and 5. Waves 2 and 4 are the counter trend waves. We can see wave 1 goes up to about July 29th and forms the second part of that trend channel. Price then pulls back, and then wave 3 is the one that breaks that downward trend channel and gives a hint to be long. Price reacts very slightly from wave 3 to wave 4, and then has a small wave 5 up, topping with the unemployment number that came out and sent prices straight down to A. Very, very dramatic move down in A. And then you have a B wave back up, and then the C wave down with a long tail, which says a lot of buyers came in. In my opinion, it's time to find support here and go long. The buy zone for me is the bottom half of this last wide range down bar at C. So roughly below a level of $23.90, $2,390 is where I was looking to go long here. Next, let's zoom in on the 30-minute bar chart. Same price action, but we're just going to zoom in a little more. This shows another pattern. This shows a head and shoulders bottom on the 30-minute chart. And also note that at the head, which is the lowest point just before the 7th of August, you see the MACD didn't make a lower low, whereas price did. That's a divergent bottom, and you're probably going to get a rally off of that, which is exactly what happened. And because of this and the rally up, I think this would prompt me to take a position long on a pullback to this congestion at the head, the 2385, 2387 area, to me would be a great place to get a low-risk buy order in, because your stop's going to be $1 or $2 below the low over there before the 7th at the head of the head and shoulders bottom. If we continue there, we see the strong move off the right shoulder, marked in the green line, goes up to the yellow trend line. It pulls back a little bit before it decisively breaks above 2400 it breaks above the high that it made at the right shoulder, and it breaks above that trend line. It just doesn't stop. It rallies straight up $15. So what would be wrong with taking a small position at the right shoulder with a small stop loss, and then taking another position on the breakout at X above the downtrend line and above the neckline of the right shoulder? Now what I do, I use the right shoulder to the neckline as the first wave objective. I know technical analysis says you're supposed to use the headline to the neck, the bottom of the head to the neckline as your measured move. I like to have a minimum price target, and I use the right shoulder to the trend line as my first target. Note that once price broke that neckline, that it promptly, in about 8 bars, rallied straight up to our objective. Now let's go to a different same bar chart, 30 minutes, but this is showing a beautiful cup and handle pattern. This is another indicator to go long. The cup and handle pattern is shown in red on this 30-minute bar chart with the breakout above 2400. You can see how it formed the rounding, not a saucer bottom, but a cup bottom at 1800, which is 6 o'clock on the 7th. And then on the 8th, it hit the neckline, had a small handle, and then decisively broke up above 2400 and ran straight up to the target. Again, we were targeting 2420. So this tells us we have short-term trend up. But let's zoom out a little bit. Let's zoom back out to the weekly bar charts and find out what might be in store longer term for gold. In my opinion, I think not my opinion, but facts is you had a strong rally from 2000 to 2430 this year. From February, in about 8 weeks, you had a $400 or $500 rally. What is that? A $430 rally. I think we do a wave projection from the lows in March or April. That puts a target on gold, I think, in the short term of $2,700 an ounce. So right here, we've got about a 15% rally possible. Of course, past performance is not necessarily indicative of future results. You can lose money trading, and this is not investment advice. I hope you enjoyed this. If you did, please like and subscribe. Let me know if you find this content helpful or any constructive criticism. Thank you so much.